We have been through a period of upheaval and shocks in the economy.
It would be very nice not to have a week where we continue to talk about inflation or inflation prints, but unfortunately that's not what we're inheriting for the environment. And one of the things we're going to be emphasizing are the changes that we've made to portfolios to deal with the environment that we are in.
We moved up U.S. fixed income to an overweight of about 10.5% from about 7.5%. We also needed, we thought, to cut back a bit on the riskier, higher beta equities within the portfolios and switch a little bit.
These are significant changes to portfolios and obviously reflect a few things. Number one, the fact that we want to move up the quality range and move away from some of the volatility that is in markets. But secondly, to understand that some of the beaten up areas in fixed income are actually particularly attractive right now.
What we really should understand here is that we have been through a period of upheaval and shocks in the economy. The range of declines and gains that we've seen in output have been truly unprecedented on the entire post-war period.
The fact that we have such high uncertainty is what's caused us to trim some of our more volatile equity themes. When you think about what equities you want to own in the environment that we're in, the idea of owning dividend aristocrats with dividend reinvestment is incredibly important. These highest quality equities have the strongest track record over long periods, but are especially good during periods when you have uncertainty because of their balance sheet quality and the actual fact that dividends and dividend payments and increases in dividends all are, in my mind, beta reducing in markets that are going stressed like this.
The best companies that turn out to be, wonderful long-term investments can get too cheap in a period like this. And again, you may not be able to do anything about that. You may not see those shares rebound until there's some clarity, right, on the extent of how far the economy will weaken. And that, right now, unfortunately, is in the hands of the Federal Reserve.
So we are shifting right now toward those more conservative areas, some of which we've been invested in before, and some of which we are adding now at this time. We're going to therefore be emphasizing investments that are going to generate higher quality results. That is to say, better quality income and less risk there.
There's a lot of uncertainty, particularly about Russia-Ukraine commodity supplies. That's some uncertainty that we may be living with perhaps for years. If we take a look at broader natural resources equities, ultimately we think these are good investments. And if you think about the natural gas industry, LNG, fertilizers, or electric vehicle related commodities, again, everything from copper and beyond, these are going to be good investments. They are on the more cyclical side, but it's worth keeping some of that in our tactical portfolios, even as we've taken other commodities down.
One of the reasons we like China as a counter-cyclical play is due to the fact that their input costs are actually lower, their inflation rate is lower, the availability of labor there, their youth unemployment rate in China today is almost 18%. And that actually speaks to us of opportunity.
So we do take some risks in portfolios. This could be wrong, but for a 2% overweight, we couple this with all of that caution we put into portfolios with U.S. bonds now more than 10% overweight.